Dennis was 64 years old, living in Columbus, Ohio, and he had spent 33 years building something he was genuinely proud of. He had started contributing to his 401k at 31, back when his company first offered it. He had stayed the course through the dot-com crash, through 2008, through every dip and recovery that made lesser investors bail out. By the time he sat down to plan his retirement, Dennis had $612,000 sitting in that account. $612,000. He had earned every penny of it. And then, in the space of about 18 months, Dennis made 5 decisions that were each perfectly reasonable on the surface. 5 decisions that felt like the responsible, common-sense thing to do. 5 decisions that his coworkers made, that his brother-in-law made, that millions of Americans make every single year. When Dennis finally sat down with a tax professional at age 66, not a financial advisor, just a tax preparer, the woman across the desk looked at his paperwork and said something Dennis will never forget. She said, "Dennis, do you know how much of your own retirement money you have already given away?" He thought she meant investment losses. She did not mean investment losses. She meant taxes, penalties, fees that compounded silently for years. Decisions that looked free at the time, but came with a price tag that nobody had bothered to explain to him. So here's the question I want you to sit with. If someone handed you $612,000 and told you there was a way to quietly drain tens of thousands of dollars from it through perfectly legal, completely common decisions, would you want to know what those decisions were before you made them? Because Dennis did not know. And by the time he found out, some of the damage was already done. According to a 2023 report from the Employee Benefit Research Institute, Americans collectively leave an estimated $100 billion in unnecessary taxes and penalties on the table every year through avoidable 401k and IRA withdrawal mistakes. Not investment losses, not market crashes, withdrawal mistakes, decisions about when to take money out, how much to take, and in what order. And a study from Vanguard found that fewer than 1 in 5 retirees has ever worked through a formal withdrawal strategy with a financial professional before beginning distributions from their retirement accounts. Most people simply start taking money out when they need it, the way they would from a checking account, without understanding that the rules governing retirement accounts are completely different and significantly more complex. This is not about being careless with money. Dennis was not careless. This is about a set of rules that most people were never taught, hidden inside accounts they spent decades building, that can quietly cost them more than they ever imagined if they do not know where to look. In this video, I am going to walk you through 5 of the most costly 401k and IRA withdrawal mistakes people make after age 60. Not the dramatic ones, the quiet ones. The ones that feel like the right move at the time. This is not about investment strategy. This is not about which funds to hold. This is not even about how much you have saved. It is about making sure that the money you spent 30 years building does not get quietly handed to the IRS, to penalty fees, or to a withdrawal sequence that shrinks your account faster than it ever needed to. Mistake number 1 is taking withdrawals before age 59 and a half. This one sounds obvious until you see how many people do it and why. The IRS imposes a 10% early withdrawal penalty on any money you take from a traditional 401k or IRA before you reach age 59 and a half. 10% off the top, before income taxes even enter the picture. Here is why people do it anyway. Life does not wait for retirement. A medical emergency happens at 57. A job loss comes at 55. A roof needs replacing at 58, and when someone looks at their 401k balance and sees $300,000 sitting there, withdrawing $20,000 to handle a crisis feels like a reasonable solution. It feels like using your own money, and here's the part most people never hear about this. that $20,000 withdrawal is not just losing 10% to the penalty, it is also added to your taxable income for the year. If you are in the 22% federal tax bracket, that $20,000 withdrawal costs you $6,400 in income taxes on top of the $2,000 penalty. You pay $8,400 to access $20,000 of your own money. Your actual take-home is $11,600. You lost 42% of that withdrawal before it ever reached your bank account. What can you do this week? If you are under 59 and a half and facing a financial shortfall, look into what the IRS calls Rule 72T, also known as substantially equal periodic payments. This provision allows you to take penalty-free withdrawals from an IRA before 59 and a half if you take them in a specific scheduled series. It is not for everyone, and it has strict rules, but it is worth discussing with a financial advisor before you take a standard early withdrawal and hand thousands of dollars to the IRS unnecessarily. Mistake number 2 is ignoring required minimum distributions and the penalty for missing them. Once you reach age 73, the IRS requires you to take a minimum amount out of your traditional 401k and IRA accounts every year. This is called a required minimum distribution, or RMD. The amount is calculated based on your account balance and your life expectancy according to IRS tables. And if you do not take it, the penalty is 25% of the amount you should have withdrawn. Here is why people miss this. They do not need the money. Their Social Security covers their expenses. Their pension, if they have one, covers their lifestyle. They think leaving the money in the account to keep growing is the smart move. So they simply forget, or never knew, that the IRS has a mandatory withdrawal schedule beginning at 73. Let us look at what that penalty actually costs. Say your RMD for the year is $18,000 and you miss it. The IRS penalty is 25% of $18,000, which is $4,500. Gone. And that is before the income taxes you still owe on the distribution once you take it. Forgetting a single RMD can cost thousands of dollars in a penalty that exists purely because of a missed deadline. What can you do this week? If you are 72 or older, contact every financial institution where you hold a traditional IRA or 401k and ask them directly, what is my required minimum distribution for this year, and have I taken it? Many institutions will calculate this for you automatically, and some will even set up automatic distributions so you never miss a deadline. Set a reminder every year in October or November to confirm your RMD has been taken before the December 31st deadline. Mistake number 3 is withdrawing from the wrong account first. Most retirees have money in several different places: a traditional 401k, a Roth IRA, a regular taxable brokerage account, maybe a pension, and Social Security. The order in which you withdraw from these accounts has an enormous impact on how much of your money survives taxation over the course of retirement, and most people get the order wrong. The most common mistake is withdrawing from a Roth IRA too early. People see their Roth as emergency money because they already paid taxes on it, and the withdrawals are tax-free. So when they need cash, they reach for the Roth first. This feels logical. It is actually one of the most costly sequencing errors in retirement. Here is why. Every dollar sitting in your Roth IRA grows tax-free forever and passes to your heirs tax-free. Every dollar sitting in your traditional IRA or 401k will be taxed as ordinary income when you withdraw it, at whatever tax rate you are in when you take it. The general principle, and please talk to a financial advisor about your specific situation, is to take from your taxable accounts first, then your traditional retirement accounts, and preserve your Roth for as long as possible. Keeping money in a Roth IRA for an extra 10 years at a 6% return on a $100,000 balance produces roughly $79,000 in additional tax-free growth. That is $79,000 that disappears if you empty your Roth a decade too soon. What can you do this week? Write down every account you have, its approximate balance, and whether it is taxable, tax-deferred, or tax-free. Then ask a financial advisor or tax professional to help you map out a withdrawal sequence that minimizes your lifetime tax bill. This single conversation could be worth more to your retirement than any investment decision you have ever made. Mistake number 4 is taking too much out too fast. This is the mirror image of mistake 2, and it is just as destructive. It is called the sequence of returns risk, combined with over-withdrawal, and it is the reason that a retirement account that looked perfectly healthy at 65 can run dry by 78. Here is how it happens. Someone retires at 65 with $500,000 in their 401k. They have heard of something called the 4% rule, the idea that you can withdraw 4% of your portfolio per year, and statistically have a very high chance of not outliving your money over a 30-year retirement. 4% of $500,000 is $20,000 per year, or about $1,667 per month. But they need more than $1,667 a month. So they take 5%, then 6%. Then in a bad market year, when the portfolio drops 20%, they still need income. So they take the same dollar amount out of a now smaller portfolio. This means they are selling more shares at a lower price to meet the same spending need. And those shares are gone permanently. They are not there to recover when the market comes back up. A withdrawal rate of just 2 percentage points above what a portfolio can sustainably support, say 6% instead of 4%, can cut the life of a retirement portfolio by more than a decade. The same $500,000 that could theoretically last 30 years at 4%. Withdrawal might be gone in 17 years at 6%, depending on market conditions and sequence of returns. What can you do this week? Look at your current or projected monthly withdrawal from your retirement accounts. Divide your annual withdrawal by your total portfolio balance. If that number is above 5%, you need to have an urgent conversation with a financial advisor about either reducing withdrawals, increasing other income sources, or adjusting your investment allocation. This is not a decision to make alone. Mistake number 5 is forgetting that every traditional withdrawal is taxable income. This one catches people off guard more than almost any other retirement mistake. They spent 30 years making pre-tax contributions to a 401k or traditional IRA. They watched the balance grow, and somewhere in their minds, they started thinking of that money as their money. Clean, full, available. It is not. Every dollar in a traditional 401k or IRA has never been taxed. The IRS is a silent partner in that account, and they will collect their share when you withdraw. And here is where people make an extremely costly error without realizing it. They make a large one-time withdrawal to buy a car in cash, to help a child with a down payment, to renovate the house. A $60,000 withdrawal sounds manageable. But that $60,000 is added to your other income for the year. If you have $24,000 in Social Security income, and you add $60,000 in retirement account withdrawals, your total income is $84,000. That pushes you into a higher tax bracket. It can trigger the taxation of up to 85% of your Social Security benefits, and it can increase your Medicare Part B premiums the following year through what is called IRMA, the Income-Related Monthly Adjustment Amount. That single $60,000 withdrawal can create a tax event that costs $18,000 to $25,000 in combined taxes, premium increases, and benefit reductions. For a withdrawal people thought was going to cost them nothing extra. What can you do this week? Before you make any withdrawal larger than your normal monthly amount, call a tax professional. Not after you take the money, before. Ask them to run a projection of what that withdrawal will do to your total taxable income for the year. your Social Security taxation, and your Medicare premiums. This phone call might take 30 minutes and cost you a few $100s in professional fees. It could save you tens of thousands. I know this is a lot to absorb. 5 different ways that money can quietly disappear from an account you spent decades building through decisions that felt completely reasonable at the time. I want to acknowledge something directly. If you have already made some of these mistakes, you are not alone, and you are not foolish. These are the rules that should be taught to every working American, and almost never are. Let me tell you what happened to Dennis. When that tax preparer asked Dennis how much of his retirement money he had already given away, she was looking at 3 years of early withdrawal penalties, a missed RMD that had triggered a penalty, and a large lump sum withdrawal. In the same year, his wife went back to work part-time, which had pushed them into a much higher tax bracket than they expected. Altogether, those decisions had cost Dennis and his wife approximately $67,000 in avoidable taxes and penalties over 4 years, not through bad investments. Through withdrawal decisions they thought were neutral. Dennis took that paperwork home, sat with it for a week, and then made 2 phone calls. One to a fee-only financial advisor who helped him build a withdrawal sequence for the rest of his retirement. One to his adult daughter, who he told, please, before you ever take money out of a retirement account, talk to someone first. He could not get back the $67,000, but he stopped the bleeding, and for the last 3 years, he has not paid $1 more in avoidable taxes than he legally has to. That is a victory, a real one. Write these down. Number 1, the 10% early withdrawal penalty before age 59 and a half is just the beginning. Add income taxes on top of that, and an early withdrawal can cost you 40% or more of every dollar you take out. Explore alternatives before you touch retirement funds early. Number 2, required minimum distributions begin at age 73, and missing one costs you 25% of the amount you should have taken. Set a reminder every year before December 31st, and confirm with every institution where you hold retirement funds. Number 3, every dollar in a traditional 401k or IRA has a silent tax partner. Before you take any large withdrawal, talk to a tax professional about what it will do to your total income, your Social Security, and your Medicare premiums that year. If this video helped you see your retirement accounts in a new way, please subscribe so you do not miss what comes next. Our next video covers the one estate planning mistake that causes more family conflict and financial loss than almost any other retirement error, and the simple document that prevents it entirely. Most people over 60 do not have this document in place. We want to make sure you are not one of them. You spent decades building what you have. Now, let us make sure you keep it.